Okay guys, so welcome to this video. We're going to look at some key economic data that's coming out today in the markets, and it's really going to drive stock markets in the long term when we're looking at manufacturing PMI data. Now remember, manufacturing PMI data is used to predict GDP growth around the world in the world's biggest economies, and it has a very high percentage of telling you how an economy is likely to perform. In the US, it predicts GDP growth with an 85% certainty going back to 1947. And if I show you some other spreadsheets where we look at manufacturing PMI compared to European growth, you do see this very strong correlation between manufacturing and GDP growth. So today, we've had manufacturing PMI data coming out in Europe. We've had it coming out in the UK, Norway, for an example, Germany, Sweden, Turkey, across the world. Now, just remember, when you have a reading above 50, so 58, 53, 54, 53, for an example, 52, a reading above 50 indicates growth in an economy, and a reading below the level of 50 indicates contraction in an economy over the next 6 to 12 months. So it's a very important driver for stock markets, for oil prices, for currencies in general. And we can see here, when we look at this manufacturing PMI data in Europe compared to GDP growth, you can see how strongly correlated the two are. So when you get manufacturing below the level of 50, you get negative prints of GDP. When you get the manufacturing above the level of 50 in blue, you get positive prints of GDP highlighted in red. Now look how strongly the two are correlated. So when manufacturing is above the level of 50 and growing, that's indicating growth is expected in the economy over the next 12 months or so, and you see GDP growth following it and getting stronger. When manufacturing PMI starts to contract, this means GDP growth is expected to be lower, and then what happens? You see exactly that. GDP starts to contract as well. So such an important indicator for predicting growth within an economy. And then we must remember that the markets then use that expectation, whether a country is going to grow or not, to then buy or sell a stock market. Because if the stock market is going to be going higher, that's because the economy is growing and these companies are making more money every year, and that's why the value of GDP is increasing. And remember, GDP is the total value of everything produced within a country over a 12-month period. So you can clearly see that's very important. If you look at the German manufacturing PMI, remember, Germany is the powerhouse of Europe, the biggest economy within the European Union. And you see exactly the same situation here. The PMI literally predicts German GDP growth, and that's very important for European growth as well. So you can see again, when it's above level 50 and growing, you have growth in GDP highlighted in red, and then when it starts to contract, you get negative growth in GDP, or contraction in growth. Okay, so that's very important for us to understand. And then when you look at the PMI data compared to the stock markets, then you can see how closely correlated the two are as well. So when manufacturing is growing, that is predicting that the economy is going to grow, and the markets then buy the stock market in anticipation of growth happening. And you can clearly see the correlation is very strong between the two. And if you look at the German PMI versus the DAX, again, is very strongly correlated. Now, we must remember the US is the world's biggest economy, so the data for the US does come out later today. ISM manufacturing, very important. Remember, the US is the world's biggest economy, so it predicts GDP growth with a very strong certainty in the United States, this manufacturing PMI, and that is indicating whether the global economy is going to grow, because if the US is growing, the world is growing, because it is the world's biggest consumer. And again, you could clearly see the correlation between the two. So that's very important to understand. And there's ISM manufacturing with US GDP growth. Look how strongly correlated the two are. And I will show you some examples of literally how manufacturing really does have a big impact on growth. Okay, this is the European index. So from 2018 to 2020, the European economy wasn't really growing that much. The manufacturing PMIs were contracting, indicating growth was not going to be that strong in Europe, and the stock market only went up over 2 years by 4.29%. You can see here. And if you go to the European spreadsheet and we go to the manufacturing data, we can see why this was, and it's because the PMI data was telling you that contraction was slowing in the economy, because look, manufacturing was above level 50, but it was contracting, indicating growth was going to be contracting. And then GDP then did start to come out lower and lower in terms of growth on a year-by-year basis. And then that means the markets knew that the companies within Europe were not going to be earning as much money, because the leading economic indicator PMI is telling you that growth is expected to contract. On the flip side, if we look at the US stock market, for an example, from 2018 to 2020, the stock market was up 20%. And why was that? If we look at the US manufacturing PMIs, there wasn't that much contraction in growth compared to Europe. So look, you can see it was kind of steady from 2018. It wasn't contracting at that stronger rate as Europe. And that's why the US market was moving higher compared to Europe, because it wasn't tailing off at the same pace as Europe. So that's very important for us to understand. Now, if you're looking at oil prices, remember I did show you this before, guys. If you're looking at how the oil price trades, now if you look at this spreadsheet here, we have US manufacturing highlighted in blue, the ISM manufacturing in the US. So again, if it's above the level of 50, we're indicating growth in the US economy. If it's below the level of 50, we're indicating contraction in the US economy. And the demand for oil is driven by global growth expectations. And because the US is the world's biggest economy, if you get levels of the PMI below the level of 50 and contracting, indicating negative growth in the US, the oil price then starts to fall, because demand will start to fall as you go into a lower growth environment around the world. And then when manufacturing is coming back towards level of 50, then getting above the level of 50, indicating growth in the US, what happens? The oil price strongly follows. You can see how strongly correlated the two are at the moment. And you can see European PMIs as well, very much strongly correlate the oil price as well, because Europe and the US are big consumers of oil. So we have to look at the ISM manufacturing. We have to look at the European PMIs to predict what's going to happen. And that can also give us a bias towards whether we want to be buying or selling the oil price. So at the moment, if we look at today's data, European PMIs are above the level of 50 and it's stable, which means that the European economy over the next 12 to 18 months is predicted to grow. Hopefully there's not a lot of lockdown measures over the next 12 months or so. And if that is the case, then we should be wanting to take long positions in the European index, the European stock market, for an example. We know it's been falling the last few days because of the lockdown measures in France, Spain, and Italy. But over the long run, this should mean that the index will move higher, as we've seen already, because we looked at here and we've seen that literally the PMI is telling us what's going to happen in the stock market. So you see the correlation between the two. Same in Germany at the moment, the economic powerhouse of Europe. PMIs are above the level of 50 today, which is positive. That's indicating growth should happen in Germany. We know that the German index did fall quite aggressively last week because of the new lockdown measures implemented in Germany. But look, again, the German index is actually just edging back to the upside at this moment in time. And it's probably been driven by the PMI data, which was positive today. So that's good for Germany. So we could potentially look to buy back the German index at some point and try to catch a retracement, because again, the PMIs are telling us that Germany should be growing. So you know how to look at PMI data now. That's just a short video explaining how this economic indicator is so important for growth, important for the stock markets, important for oil prices. And now you can start to look at this data and understand it and know how to interpret it yourself when the data is coming out. Okay, guys, that's manufacturing PMI data. Thank you.